What if I told you that the most famous rule in retirement planning could leave you broke by age 75? The 4% rule has been gospel for decades, but here's the uncomfortable truth. It was designed for your parents' world, not yours. And if you're banking on it for your financial independence, you need to hear this. I'm about to show you exactly why the 4% rule is broken for anyone retiring in the next 30 years, and more importantly, what actually works instead. By the end of this video, you'll have a completely new framework for calculating your real safe withdrawal rate. Let's dive in. The 4% rule comes from something called the Trinity Study, published way back in 1998. The idea is simple. Withdraw 4% of your portfolio in year one of retirement, then adjust that dollar amount for inflation each year after. The study claimed this would make your money last 30 years with 95% confidence. Sounds perfect, right? Here's the problem. That study used historical data ending in 1995. Think about what's happened since then. We've had the dot-com crash, the 2008 financial crisis, unprecedented money printing, near-zero interest rates for over a decade, and inflation hitting 40-year highs. The economic landscape has fundamentally changed. But here's what really breaks the 4% rule for your generation. First, you're likely to live longer than the 30-year retirement period the study assumed. If you retire at 35 following the FIRE movement, you need your money to last 50 or 60 years, not 30. Second, the study assumed a 50-50 stock-bond portfolio, but with bond yields near historic lows for years, that allocation doesn't generate the same returns it used to. Third, and this is huge, sequence of returns risk. If you retire right before a major market crash and start withdrawing 4% immediately, you could deplete your portfolio much faster than the historical averages suggest. The Trinity Study didn't adequately account for this timing risk. Let me show you some real numbers. If you retired in 2000 with $1 million and followed the 4% rule, withdrawing $40,000 that first year, you would have run out of money by 2020. That's just 20 years, not the 30 the rule promised. The same thing would have happened if you retired in 2007, right before the financial crisis. So what's the real safe withdrawal rate? Recent studies suggest it's closer to 3% or even 2.5% for longer retirement periods. That means if you want true financial independence, you might need 30 to 40% more money than the 4% rule suggests. But before you panic, there are smarter approaches. Instead of a fixed withdrawal rate, consider a flexible strategy. In good market years, you can withdraw more. In bad years, you cut back. This dramatically improves your portfolio's longevity. Another approach is the bond tent strategy. As you approach and enter retirement, you gradually increase your bond allocation to reduce volatility. This helps protect against sequence of returns risk. You can also use a bucket strategy. Keep 2 to 3 years of expenses in cash or short-term bonds, 5-7 years in intermediate bonds, and the rest in stocks. This way, you never have to sell stocks at the worst times. Here's what I recommend for modern retirement planning. First, use a 3% withdrawal rate for initial calculations, not 4%. Second, build flexibility into your withdrawal strategy. Third, consider dividend-focused investing as part of your portfolio. Quality dividend stocks can provide growing income that helps offset inflation without requiring you to sell shares. Fourth, don't ignore alternative income streams. Rental real estate, business income, or part-time work can reduce pressure on your portfolio. Fifth, regularly stress test your plan. Run scenarios with different market conditions, inflation rates, and withdrawal strategies. Now, let's talk about what this means for different age groups. If you're in your 20s or 30s and following FIRE, you need to save significantly more than the 4% rule suggests. Plan for a 3% or even 2.5% withdrawal rate. If you're in your 40s with a traditional retirement timeline, you have more flexibility. You might still use 3.5% or even 4% since your retirement period will be shorter. The key is matching your withdrawal rate to your specific situation. Your timeline, risk tolerance, flexibility with spending, and other income sources all matter. Here's a practical framework you can use right now. First, calculate your annual expenses in retirement. Don't forget health care, which tends to increase with age. Second, multiply those expenses by 33 for a 3% withdrawal rate or by 40 for a 2.5% rate. This gives you your target portfolio size. Third, stress test this number. What if inflation runs higher than expected? What if you live to 100? What if there's another 2008-style crash right after you retire? Fourth, build in backup plans. Maybe that's part-time work, reducing expenses, relocating to a lower-cost area, or having multiple income streams. The bottom line is this: the 4% rule was a starting point, not gospel truth. For your generation, facing longer lifespans, different market conditions, and unique challenges, you need a more sophisticated approach. Don't let outdated rules derail your financial future. Use the strategies I've outlined today to build a retirement plan that actually works in the modern world. The math might be more conservative, but your peace of mind will be worth every extra dollar you save. What's your target withdrawal rate? Are you planning for 4%, or have you already adjusted your numbers? Let me know in the comments below. And if this video helped reshape your retirement thinking, hit that like button and subscribe for more evidence-based financial strategies. Your future self will thank you.